Welcome to GrowFlow Finance. In today's video, we're breaking down the basics of options trading in a way that's easy to understand, even if you're just getting started. Options might sound intimidating, but at the core, an option is simply a contract between two investors. It allows one of them to speculate on the future price of an asset, like a stock, without actually owning it. Let's say a trader believes Tesla's stock will go up in the next 3 months. We'll call him the Tesla bull. He doesn't want to buy the stock directly, so instead he finds another trader with the opposite opinion, the Tesla bear. They agree on a contract. The bull gets the right to buy Tesla stock at a fixed price, let's say $165. After 3 months, this fixed price is called the strike price or exercise price. Now imagine Tesla's stock rises to $190 at the end of those 3 months. The bull can buy at $165 and sell at $190, making a $25 profit. But if Tesla's stock falls below $165, the bull can choose not to buy, avoiding a loss. So what does the bear get out of this deal? The bull pays a premium, say $10, up front. This amount is non-refundable, and the bear keeps it whether the bull profits or not. So if the bull profits $25, after subtracting the $10 premium, the real gain is $15. And if the bull chooses not to buy, he loses only the premium, which becomes the bear's gain. In this case, the bull used a call option because he was bullish. A call option gives the buyer the right to buy at a set price. On the flip side, if someone is bearish, they can use a put option, which gives the right to sell at a set price. For example, if the strike price is $165 and the stock drops to $140, the put buyer can sell at $165 and pocket the difference. The price you pay or receive for an option, the premium, depends on 3 main things. 1. Intrinsic value, how much the option is in the money. 2. Time value, more time until expiration usually means higher premium. 3rd, implied volatility, higher volatility means higher premium. Option buyers can only lose the premium they pay, but have unlimited profit potential. Option sellers have limited profit, the premium, but face unlimited potential loss. Thanks to modern brokerages, trading options today is fast and easy. Just select your asset, choose a strike price, and either pay or receive the premium. But how do you trade profitably? You need a system. For example, some traders use technical analysis to spot breakouts and buy options accordingly. If Tesla breaks above a resistance level, that might be the trigger to buy a call option. Options are highly leveraged instruments. A small move in the stock can lead to a big move in the option premium. For example, if you buy a $10 premium when the stock is at $100, and the stock goes to $120, the premium might jump to $25. That's a 150% return, even though the stock only moved 20%. But the reverse is also true. A 20% drop in the stock could cause your option to lose 90% of its value. The best options traders never risk more than 2% of their capital in a single trade, because options can go to zero fast. So start small, learn the craft, build a system that gives you consistent, positive returns. Thanks for watching GrowFlow Finance. If you found this guide helpful, make sure to like, subscribe, and turn on notifications for more simplified finance content. Let us know in the comments, what topic should we cover next in the world of trading?